Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Medifast Inc. Well, this is a stock that I got a lot of requests from subscribers some months ago and I've neglected doing, but I'm finally going to cover it now, so stay tuned for a good video. But before we get into the analysis, of course, make sure to subscribe to my channel, Balance Sheets Matter. I do lots of individual stock analysis videos, so if you want to get ideas on potential good stocks to buy, value traps to avoid, or just understand the financials of a company better, make sure, of course, to subscribe to my channel. So before we dive into Medifast too much, let's just look at some of the top overall views, and then I want to get a little bit into their business model as well before we look at the details of financials. So a lot of people are very interested in this stock because you might actually see here PE of 3.83, looking extremely cheap. It's also a kind of a small micro cap company. The market cap right now is only 378 million, so it is very small, and they were having some really aggressive growth for a while, and that's come to a little bit of a problem. Also, even those interested in the dividends, they have a high dividend yield of 14.27, and the payout ratio is 0.51, but that's not all that it seems. But what basically is Medifast? They're kind of I wouldn't call them an MLM per se, but they kind of have this direct coaching program where you can see here they have these Optivia coaches, 47,000 of them, but this dropped from 66,000, which promote healthy lifestyles, eating, and they sell also products on their website and e-commerce. So you can see here on their website, you can go in, they have this, and this is really all sold through this kind of quasi MLM direct coaching model. And this gets into one of, I'll say, the overall problems, or not problems, but just things to be aware of these business models here is when you kind of have this MLM and you're getting direct coaching, you can grow really aggressively, but then you do kind of eventually hit this point where you hit saturation and things can either go downhill or plateau. There also is the overall problems in the weight loss market for them, of that now there's drugs like Ozempic and other ones that people are losing weight on and kind of switching away from, your old school way of weight loss. So, that is been harming them a lot in the interim. But as we get into that, let's dive into the financials, because we're going to be able to see all that and we can explore it a lot more. And you can see on the right here, the chart, very aggressive growth going up, basically lots of revenue growth, and then huge contractions happen recently. We've gone from about 1.6 billion down to just over $1 billion. So the last 10 years, it was growing 23% per year. And now the revenue growth in the last year, 30% negative. So that's a huge issue for them. And that's largely why the stock has been crashing so much. And we're going to get into the implications of that, and if there's even possible to kind of get an idea of where they might be going forward. So go down the financials here. Again, you can see this looks like a great company. Revenue growth is going great. There's high basically gross margins. Operating margins are pretty decent as well. But then you get this huge contraction, and that's where the problem basically starts lying. It's also, even though they have these high gross margins, because they basically have this, various independent coaches, their expenses, which are kind of required and fixed because they're the ones distributing the product, do pop up in the selling and general admin here. So you can see at the end of the day, the gross margins are pretty low, even though, or the operating margins are pretty low, just in the around 10%, maybe a little bit higher, maybe a little bit lower compared to the gross margins that are, above 70%, sometimes in the 75% range. So for a company like this, just because they have high gross margins because of their business model, it's completely irrelevant, because for them to achieve any of these gross margins, they have to have a scalable, basically, amount of people promoting their programs, promoting their products to do it. So just don't be deceived by the high gross margins. And we really get into the quarterly data to actually see how much damage has started occurring in the recent years. You can see 1 year ago, quarter ending in December 2022, revenue was 337 million, and now that's down to 191 million. So that is an extreme decrease in revenue, and that is not very good. As you can see, basically, operating margin, from 1 year ago there was 9.67, and now it's down to 4.54, and operating income dropped from $33 million down to $9 million. So that's not good. And, there could be more contraction going forward in the future. We really don't know, because of this kind of paradigm change in weight loss of people jumping on Ozempic and other drugs to basically lose weight, rather than the old kind of fashioned way of, coaching, calorie control and trying to eat healthy and stuff like that. But let's go into their financials and start looking at some of the good stuff. Well, one of the good things, they basically don't have any interest expense. So even though the revenue is dropping, it's not, they don't have to worry too much, because as long as they can keep this operating income positive, they have no interest expense. So they have no baggage basically on the business right now that's holding them back. Although I will just kind of come back to this line here and kind of show that even though their, the selling and general admin is dropping, it's not dropping proportionally to what the revenue is. So this is relatively still kind of high for the amount of drop they had, which is why basically the operating margin has contracted severely. So this is something that they're going to either have to kind of maybe restructure in their business, their internals, cut a whole bunch of costs to get this operating margin back up, or we could be seeing lower ones in the future. So you kind of have to look at what they may be doing for that to see if they're going to be able to get this back up to maybe about a 10% in the future, and what potentially, the revenues, could be going forward in the future. But based on a one quarter like this, it could be getting a lot lower of, under $800 million. So that's a huge basically setback compared to where they previously were. But overall, even with all these problems, the net income was still positive at the end of the day. They got to pay some taxes, unfortunately. High tax bracket for their business in. It's obviously been relatively high, but net margins, again, just a reflection of what their operating margin was minus taxes. EPS, has been great, but now we're back down to 0.5 EPS. So you kind of start looking at the stock now, which is $34, and if they're only to make $2, multiplying this by 4, basically, their EPS and their PE would not actually be very good. So what can look at a 3.38 PE, which looks really low because their EPS and their earnings have severely contracted. That may mean that their forward PE might actually be pretty high. And for a small little kind of micro cap, small cap company like this, it's very unpredictable what they may be doing in the future. You can see overall there has been a little bit of share buybacks, though. Some people think this is always good. I'm going to kind of show you why I think this is, again, was a little bit of a mistake, because when they were decreasing their shares, the share price was a lot higher. So you kind of just like threw away all the money the company's made at effectively bad prices. And that's, the double-edged sword of share buybacks. We go into their balance sheet. Their balance sheet overall is pretty good. You see total current assets, $224 million. A lot of this is basically sitting in cash and cash equivalents, which is going to be important for later. So remember, they do have basically about $150 million in cash and cash equivalents. And inventory and finished goods is relatively low. You can see they've severely trimmed this down compared to what it was before. So overall, this doesn't seem to be in the worst place they were. Maybe before they also might have had, I didn't dive too much into the detailed quarterly data, but it looks like, from December 2022 here, the quarter ending there, they had basically over $100 million in inventories, and they've started trimming it down basically with their thing. So maybe just like a lot of other people, they got a little bit overstocked on the inventory, and also with the decrease in sales, they have to decrease it down, but that has gone pretty well. So not really seeing a problem there, just an observation. And that's compared to the total current liabilities of $92 million. So overall, their current ratio is very good. They can easily pay all their short-term debts over, even just with the cash on hand, $150 million cash, cash and marketable securities on hand, total current liabilities, they can pay them all off. Overall, very healthy for that. Total liabilities, they almost have no long-term liabilities, no long-term debt, as we've basically seen, just some capital leases. So basically, balance sheet wise, this company is looking very, very good. And there is total stockholder equity of about $200 million. Although let's pop over to the total assets to see where that all is. You can see it's mainly in plant, property, and equipment, and other stuff like that. So fairly tangible, fairly reasonable. So they do have real intrinsic value in the company on the balance sheet, which is kind of a buffer. But especially with small companies like this, if they ever were to start losing money, all of that comes quite irrelevant, because everything they built up, you can lose it just as quickly. So let's now take a look at the cash flow statement. Cash flow statement, pretty basic, good cash flow from operations, stock-based compensation. There's a little bit there. It's relatively low, and they kind of, I guess, bought back some shares to offset it a little bit, but not really too much stock-based compensation going on. You look at basically the cash flow long-term from depreciation, compare it to the purchase of plant, property, and equipment, probably averaging this all out. It's just basically at replacement value. They've started dipping their toes in a little bit of acquisitions here, showing basically a $55 million acquisition in basically the last year. And there's been some other little ones along the way. They also do mention this basically in their report, that they are trying to, expand and be the new revolutionary thing of doing strategic acquisitions that kind of, complement their business. But overall, it's like good balance sheet, cash flow statement's fine. I'll say this one thing here is when we get into the repurchase of stock, is this is the issue I have. When you have these good years and you just like focus too much on repurchasing stock, let's look at this basically from 2021, 2022, they almost spent $200 million in repurchasing stock, which is, a lot of their basically long-term historical profits when you look at down today. And we can quickly just pop over to the sheet here or the chart here. Well, what was this? This was basically during the peak high. So the stock is $34 now, and they were buying back these shares at terrible price. So they threw basically all their money they've made away, unfortunately, into share buybacks at unfavorable prices. Because maybe they didn't see the contraction happening, but that is the risk of stock buybacks. And now that the stock price is a lot lower, these stock buybacks have completely basically stopped, because easy to buy back stock when times are good, so you end up buying back stock price high, and but then when times get bad, you don't have the cash flow, then you stop doing it, which is kind of why you have to think about, are these share buybacks really good? And as we can see from basically the amount they increased shares, it was pretty irrelevant. So most of this money has just been pissed away, unfortunately. They have been increasing their dividend over time. You can see it's about $18 million a quarter right now. And for the short term, this is maintainable. We know they have about $150 million in cash and cash equivalents on hand. But remember how much basically their net income was down to. Just scroll back up there in case you forgot. Where is it there? And you can see the net income basically in the last quarter was $6 million. So unless they really do something to get the selling and general admin under control, they drastically have to do this basically very quickly to even maintain that dividend, or it's very likely going to be cut. And based with this momentum, I probably would be expecting a dividend cut going on in the future. I don't know if they've even announced one, but I would basically expect one if they're going to be doing under $800 million. The operating income there, with a good gross margin, was like, $91 million when they did $714 million in 2019. And you look at the amount of dividends they're paying, they would barely be able to cover this now, and this is with higher margins. So I probably am going to be expecting the dividend to be cut. I wouldn't expect it going down in the future, because they are having those problems. So this is kind of the story you can have with these small cap companies that look like they're growing really well. Well, anything can pop up, stuff out of your control, and you can basically just hit a roadblock, and it really puts you into a bad position. And that makes it really hard to value the company, since I don't know what they're going to be doing in the future. And now we just kind of get into the chart and see what that's basically saying. This is just in a complete free fall right now. And when you see a stock like this doing this, it's kind of just saying, just like basically don't touch it. It's like you're probably going to want to wait for some type of bottoming pattern, and that's going to signify where the company is stabilizing basically in its revenues and earnings. Something like this, something like that, something like that, something like that. And these are three different levels I have just from technical standpoints where the stock could possibly go. So overall, it's an interesting stock. I wouldn't really bet too much on really aggressive growth in the future. If you compare it to stocks like, Weight Watchers was growing, and then they've been in a long-term decline basically in revenue since, but they had some, a worse balance sheet and this and that. So you're going to have to see how this company evolves, see where basically the revenue stabilize. It's far too early to say right now, so I don't see any purpose of really buying this until you start seeing some consistent quarters of stabilization, because probably what's going to happen is you're going to see the revenue kind of drop and stabilize, and then you're also going to start seeing where the operating income stabilizes. And then at that point, I would only be looking at basically paying a price in the future in a no growth really scenario, and see really what the cash flows are producing there. And that would probably mean pricing it under a 15 PE ratio and not as a growth company anymore. And this is even in the case if you think it's going to grow in the future, because, well, it may grow short term or long term. We don't really know. But what's probably going to happen is the market's going to figure out a price for this company in a no growth scenario when basically the revenue decline stabilizes. So overall, I would keep this on my watch list, but, it could be a while till there's any possible buy in it. And probably by the time when you get a bottom, you want to wait for like a pretty long chop at the bottom. Since if you actually look at this, this is September 2011 to May 2012. So you got a lot of time waiting there. Here at bottom, December 07, and it was until March 09 that you actually want to buy in the stock. So even if you are interested in this stock, I would really suggest basically sitting on the sidelines and just waiting for the company to stabilize till you can actually figure out what some reasonable assumptions basically for their cash flows, for their earnings are going to be going on in the future. And personally myself, I would wait till a price once they're stabilized that I'm buying it in a no growth scenario as well. Even if they do potentially get some growth, then you're really just getting a lot of extra, that extra cherry on top, and it could be potentially a good game. But right now, basically, right now what we're seeing, the knife fall, I wouldn't touch it. This could be at a support level, but again, you'd probably want to be waiting for this to bottom all year. Also, just from the another perspective to understand is that there's a tax loss harvesting. People who own the stock up here, they're probably going to be selling at the end of the year, no matter what's happening for the tax loss harvesting, even when things kind of start stabilizing. So maybe if things stabilize, get to see what's happening at the very end of the year, and you're probably going to have a lot of selling pressure just from people basically selling the stock to tax loss harvest who bought it back here. But it's most likely not going to be getting back up to these levels anytime soon in the future. So anyways, that's my basically thoughts on Medifast there. Could be a potential buy in the future. I'm watching. We're going to have to see how it evolves really from the fundamentals and a little bit of the technicals, but make sure to subscribe to my channel, like the video. If you do want me to cover a stock in the future, make sure to leave it in the comments below. Let me know your thoughts about Medifast or whatever else, and I will see you in the next stock analysis.